Audio Jungle.
A real estate investment trust (REIT) is a company owning and typically operating real estate which generates income. Most REITs specialize in a specific real estate sector, focusing their time, energy, and funding on a real estate horizon. However, diversified and specialty REITs often hold different types of property, such as apartment complexes, data centers, office buildings, retail centers, and many more. Most REITs have a straightforward business model. The REITs leases space and collects rents on their properties, then distributes that income as dividends to shareholders. Most REITs are publicly traded like stocks, making them highly liquid, unlike most real estate investment.
Types. There is equity, mortgage, hybrid, public trade, public non-trade, and private. Among of them is equity rates. There is most common form of enterprise. These entities buy, own, and manage income producing real estate. Second, mortgage rates. There is also known as a REITs, lend money to real estate owner and operator. The lending may be either directly through mortgage and loan, or direct or indirectly through the acquisition of mortgage-backed securities. Third, hybrid. Enterprise hold both physical rental property and mortgage loan in their portfolio.
Now we continue for the three more types of REITs. First is a public traded REIT. Offer a share of a publicly traded REIT that is on a national security exchange, where they are bought and sold by individual investor. They are regulated by the U.S. Security and Exchange Commission, CEC. Okay, next. That is public non-traded REITs, also registered with the CEC, but don't trade on national security exchange. As a result, they are less liquid than publicly traded REITs, but tend to be more stable because they are not subject to market fluctuation. And lastly is private REITs. Private REITs are not registered with the CEC and don't trade on national security exchange, but they work solely as a private placement, selling solely to a select list of investors.
I will explain what is the advantage of REITs. First, higher dividend. The requirement to pay at least 90% of their income as a dividend is a primary reason why investors buy REITs, like Simon Property Group. And the second one is portfolio diversification. Generally, real estate prices aren't correlated to stock prices. They can move together or in completely opposite direction. Adding REITs to a diversified investment portfolio may provide much needed diversification. The third one is liquidity. REIT shares are traded on the major stock exchanges. This makes buying and selling very easy. In contrast, buying and selling property requires a lot of effort, expenses, and expertise. Another advantage is professional management. REITs like Vantage, VTR are managed by highly skilled and experienced real estate professional managers. Average investor may not have the skills to manage high income bearing properties. Last but not least, transparency. The Securities Commission registered REITs are required to make regular disclosures. This makes REITs operation more transparent to investors.
Disadvantage of REITs. Firstly, it grows at a slower pace. REITs can only reinvest at maximum of 10% of their annual profit into their core business lines each year. This may cause the REIT grow at a slower pace than a normal company at a Wall Street. The secondly is real estate is cyclical business. REITs like Simon Group Property have to pay 90% of their income as a dividend. The income stream isn't guaranteed. Cyclical business in the real estate market could make REITs unstable. Thirdly is tax treatment. REITs like Equity Residential are required to pay at least 90% of their disposable income to unit holder. They don't have to pay tax on profit. However, the investor will have to pay income tax on the annual dividend as to its personal income, not a capital gain once it's distributed. So, investors in the higher tax bracket may have a disadvantage because have to pay high tax. Last but not least, property tax may rise. State and municipal authorities have right to increase property tax to increase their budget revenue. This reduces tax earnings.
REITs may be publicly registered with the SEC and have their shares listed and traded on major stock exchanges. Or they may be publicly registered with the SEC but not have their shares listed or traded on major stock exchanges. Or they may be private companies, not registered with the SEC and not listed or traded on a stock exchange. Regardless of the type, REITs operate under a specific set of rules established by Congress. A REIT is an entity that is modeled after mutual funds, is treated by the Internal Revenue Code as a corporation, must be widely held by shareholders, must primarily own or finance real estate, and must own its real estate with a long-term investment horizon. The IRS implements the REIT rules and oversees what qualifies as a REIT. The Internal Revenue Code requires a REIT to adhere to the following essential rules. At least 75% of the corporation's income must be earned from real estate as rent, real estate interest, or from the sales of real estate assets. At least 75% of the corporation's assets must be real estate assets. At least 95% of income must be passive. REITs are required to distribute at least 90% of taxable income annually to shareholders as taxable dividends. In other words, a REIT cannot retain its earnings. Like a mutual fund, a REIT receives a dividends paid deduction, so no tax is paid at the entity level if 100% of income is distributed. REIT shareholders pay taxes on dividends at ordinary rates versus the lower qualified rate. The top ordinary rate is now 39.6%. Over time, REITs and the rules and regulations that govern them have evolved to meet the changing needs of the real estate industry and the broader economy. But throughout that process, REITs have remained true to the mission laid out by Congress in 1960 to make the benefits of income-producing real estate accessible to anyone and everyone. And that's still how they work today.